Hi, welcome to a special market update. We're going to be looking first at the cash S&P. A lot of uh, things on here, so let's go through these. First of all, the moving averages we like looking at to define an intermediate term trend. We'll look at a 20 and a 50-day moving average, and this is the purple or blue line is the 20-day moving average, and the red line is the 50-day simple moving averages. And we could see where the blue circle is. We had the 20 crossing above the 50. In Japanese terminology, that is called a golden cross. That's when a short-term moving average crosses above a long-term moving average, and that helped improve the intermediate term picture. More importantly to me, however, was notice this rectangular portion in blue. This is a multi-month trading range. The S&P broke above it, pulled back a little bit, but essentially held above this old resistance area, 1225, give or take a few points. So that to me keeps the intermediate term trend in positive territory. So I do like the market from a longer term perspective. The market did pull back. This obviously is a doji. The opening and closing are the same. And some of you a little bit more sophisticated will recognize this as an evening star pattern. Tall white, small real body, in this case a doji, then a long black real body, getting more than halfway into the white real body. So that's why the market did pull back. We've been kind of treading water here for the last few weeks, but all in all, as long as the market holds above 1220 or so, I would view the longer term scenario as bullish. And while we do have resistance at the high of the evening star, about 1300, to me, the more important resistance, as shown on the left here, are the highs made back in July around 1350. Moving on to gold, interesting market. Whether you trade gold or not, a lot of people will watch it because it is an important indicator. And what we had here was a dead cross. That is when the shorter term, in this case the 20-period moving average, crosses under the longer term, that is the 50-day moving average, called a dead cross, dead cross, and that did turn the intermediate term trend down. But very interestingly, and this is why it's great to be involved with what we call Nison candlesticks, candlestick trading the right way. Notice these red lines here, the rectangles. This was almost, not quite, but almost a bearish engulfing pattern with a black candle wrapped around the white candle, and it missed it only by a few cents, really. But this was a classic bearish engulfing pattern, black real body wrapping around the right real body, right around where the first pure bearish engulfing pattern or almost bearish engulfing pattern emerged. And what's interesting is these were the reversal signals, especially the second classic bearish engulfing pattern, that we got that the market was losing steam, that the trend was going from up to at a minimum neutral or maybe even down weeks ahead of where we got the signal with classic Western technicals, that is the moving average. Keep in mind, when we're looking at Western technicals, they're pretty much all lagging indicators. Candlesticks are real time. They're what's happening now. So it is not surprising that we get these early reversals well ahead of traditional Western technicals. Likewise, in the blue arrow that I just highlighted back in September, this was a hammer. The lower shadow was multiple times the size of the real body. Unfortunately, in the real world, you couldn't do anything with this because by the time you got the signal with a hammer, the market had gotten as low as 1540 and closed at around 1625. So if you bought here, the risk is all the way to the low of the hammer. But nonetheless, the market, this was a sign of stabilization. And as often happens, a lot of times we get back into lower shadow before the market rallies again. And I'm positive in gold, although we're in a box or lateral trading range, judging by the action over the last few weeks. But very similar to what I was talking about in the S&P, the market here, I'm circling with the arrow, was in a trading range for quite a few weeks. It broke above it. Okay, had a little bit of a retracement here, another hammer over here. So the fact that we're holding nicely above this old box range or the top of the old resistance area does keep a positive bias to gold, as well as the fact that the 20 is has crossed above the 50-day. But I would not be placing too much emphasis on these moving averages because you can see it just recently crossed over, and it's more ideal when both the 20 and the 50-day are moving up. Right now the 20-day is moving up. In other words, the slope is pointing higher, but the 50-day is kind of lateral. So to me, this bullish or golden cross is not as important as the fact that the market broke above a resistance area.